Welcome to the deep dive. Sometimes it feels like picking stocks is just guesswork, right?
Mm-hmm. Pure chance sometimes.
Yeah, exactly. But today we're diving into something that can give you a real, a decisive edge. We're talking about understanding financial
Right.
statements.
Forget the noise, forget the speculation. This is about understanding the fundamentals.
It's about knowing what's actually happening inside a company. And I'm really excited because this comes straight from an article I just put up on my site, bullishbooks.com. I was looking for a guide myself,
Huh.
something straightforward.
Yeah, cutting through the jargon.
Exactly, making it practical, actionable. So that piece really breaks down this seemingly complex stuff into something you can actually use.
And that's the plan for today's deep dive. We want to give you the tools, no matter your financial background, to really read these reports. Make the complex simple.
Simple and actionable. So in my article, I call the three core statements the vital signs of a company. You've got the balance sheet,
Hmm.
the income statement, and the cash flow statement.
And when you understand how these three work together, it's powerful. You start to see how well a company uses its money, how efficient it is.
And if it's actually building long-term value, that's the key.
Definitely. And remember, these aren't just random numbers companies pull out of thin air. There are standards.
Right, like GAAP here in the US, generally accepted accounting principles, and IFRS internationally.
Exactly.
Yeah.
Standardized frameworks. Plus, they get audited regularly, which adds that layer of reliability. Helps you compare apples to apples, so to speak.
Okay, good point. So where should we start? The balance sheet?
Yeah, let's start there. Think of the balance sheet as a financial snapshot, like a photo capturing the company's financial position at one specific moment in time.
Okay, so just one day, not over a period.
Exactly. A single point in time. It shows what the company owns and what it owes on that day.
And the core idea behind it, the fundamental equation, is assets, liabilities, plus shareholders' equity, right? I hammered that home in the article.
Absolutely. It's the bedrock. Everything a company owns its assets had to be paid for somehow, either with borrowed money, which is liabilities, or with the owner's own money, which is equity.
Makes sense. So let's break down assets first, what the company owns.
Right. Assets are resources the company controls that have economic value, things expected to bring future benefits.
And we split those into two main types, current and non-current.
Yep. Current assets are things the company expects to convert into cash within about a year. Think short-term stuff.
Okay, like what?
Well, first off, cash and cash equivalents. This is the actual money in the bank or things easily turned into cash, super liquid. Think about Apple. A company that size needs a lot of cash on hand for flexibility, operations.
Sure, day-to-day stuff, and then marketable securities.
Right. These are short-term investments. Maybe Apple has some extra cash they don't need immediately, so they invest it to earn a little return. Still pretty easy to sell if you need the cash.
Okay. Then accounts receivable, that's money customers owe the company.
Exactly. Money owed for products or services already delivered. You usually see it listed as net, meaning they've already estimated some portion might not get collected bad debt.
Ah, okay. And inventory. For Apple, that's iPhones, MacBooks.
Precisely. The actual products, ready for sale. Managing inventory is crucial. You don't want too much cash tied up, but you need enough stock to meet demand. It's a balancing act.
Got it. And the last one, in current assets, prepaid expenses.
Yeah, things paid for in advance, like paying an annual insurance premium up front. The benefit stretches into the future, but it's usually within the year.
Okay, that covers the short-term stuff. What about non-current assets, the long-term value builders?
Right. These are assets the company plans to use for more than a year. The big one is usually property, plant, and equipment, PP&E.
Like Apple's headquarters, their factories, stores,
Yep.
physical things.
Exactly. And again, you often see a net value. That's the original cost minus all the depreciation that's been recorded over time. Reflects wear and tear.
Okay. What else is non-current?
Long-term investments. These could be investments in other companies, maybe strategic partnerships held for over a year.
And intangible assets, things you can't touch.
Yep. Still very valuable, though. Think patents protecting Apple's tech or their brand name or trademarks. Huge value there, even if it's not physical.
Okay, so that's the asset side, what they own. Now, how is it all paid for? Liabilities and equity.
Exactly. Liabilities are what the company owes to outsiders. And just like assets, we split them into current and non-current.
So current liabilities are debts due within a year.
That's right. First up is accounts payable. This is money owed to suppliers. For Apple, maybe the company's making their chips or screens.
Makes sense. What else?
Short-term debt,
Yeah.
any loans or borrowings that had to be paid back within the year.
Okay.
And then there's a sort of catch-all category.
Yeah.
Other current liabilities. This can include things like salaries earned by employees but not yet paid, taxes owed, or even customer payments for services not yet delivered. That's called unearned revenue. Dividends payable fits here too.
Gotcha. So lots of little short-term obligations grouped together. Then non-current liabilities. Things due further out.
Yep. Obligations beyond 1 year. The main one here is usually long-term debt. Think bonds the company issued or bank loans with repayment terms longer than a year.
All right.
You also have deferred tax liabilities. These pop up because of differences between accounting rules and tax rules. Basically, taxes that will be owed later.
Okay, that's a bit complex.
It can be, yeah. And finally, pension obligations. If the company has promised retirement benefits to employees, they need to account for those future payouts.
Right. Okay, so we have assets and we have liabilities. You mentioned deriving metrics, working capital.
Yes, working capital. It's a really important one. Simple calculation. Current assets minus current liabilities.
And that tells you.
It gives you a quick snapshot of the company's short-term financial health. Does it have enough easily accessible resources to cover its immediate debts? It's like the company's operational breathing room.
Breathing room. I like that. So positive working capital is generally good.
Generally, yes. It means you can cover your short-term bills. But like I mentioned in the article, context matters. A super high working capital for a tech company might mean they aren't reinvesting cash fast enough. For a manufacturer, low working capital could signal trouble paying suppliers.
Interesting nuance. Okay, last piece of the equation. Shareholders' equity. The owner's stake.
Exactly. If you theoretically sold all the assets and paid off all the liabilities, whatever's left over belongs to the shareholders. That's equity.
And what makes up equity?
Two main parts typically. First, capital stocks. This is the money shareholders originally invested when they bought shares directly from the company, like in an IPO.
The initial investment.
Right. And the second part is retained earnings. This is all the profit the company has made over the years that it hasn't paid out as dividends. Instead, it's reinvested back into the business to grow it.
Accumulated profits kept in the company.
Now, you mentioned Apple earlier, and this is where it can get a bit counterintuitive sometimes.
Yeah, in the article, I talked about how Apple sometimes shows an accumulated deficit in equity, even though they're hugely profitable and paying dividends. How does that work?
It seems odd, right? But a big reason is share buybacks. When Apple buys back its own stock, that reduces shareholders' equity on the balance sheet. They've been doing massive buybacks for years.
So even though they're making money hand over fist, the buybacks can actually make the equity figure look negative or low?
Precisely. It's a perfect example of why you can't just look at one number or even one statement in isolation. You need the whole picture: balance sheet, income statement, cash flow.
Definitely. Okay, so a good takeaway for listeners. Think about a company you know, maybe your favorite coffee shop or a tech company you follow. Try to imagine what assets they'd have: buildings, equipment, cash, and what liabilities, loans, supplier payments.
Yeah, just doing that mental exercise starts to make the balance sheet feel more real, more tangible.
Okay, great start. So the balance sheet is the snapshot. What about the income statement? That's more like a movie, right?
Exactly. The income statement, or the P&L, profit and loss, shows performance over a period of time, a quarter or usually a full year.
Yeah.
It tells you if the company actually made money during that period.
How much came in, how much went out in expenses, and what was left over.
Pretty much.
Yeah.
It shows how effectively they turn sales into profit. It usually flows top down, starting with the big number: revenue.
Revenue or net sales. For Apple, that's iPhones, Macs, services like Apple Music, iCloud, all the money coming in from customers.
Right. And when you look at revenue, you want to see trends. Is it growing? How? Are they raising prices? Are they too reliant on just one product, like the iPhone?
Good questions. Okay, so after revenue.
Right below revenue, you have the cost of goods sold, or COGS. These are the direct costs of producing whatever they sold.
So for Apple, the components, the factory labor, shipping the finished phones.
Exactly. Direct costs.
Yeah.
And the relationship between revenue and COGS is super important. Revenue minus COGS gives you gross profit.
Gross profit. Why is that so critical?
Because that's the money left over to cover everything else. All the operating costs, research, marketing, salaries plus interest, taxes, and hopefully leave a profit for shareholders. If your gross profit isn't healthy, you're in trouble.
Okay, so gross profit funds the rest of the operation. What are those other operating costs?
We call them operating expenses. They're the costs of running the business, but not directly tied to making a specific product. A big one, especially for tech, is research and development, R&D.
Essential for Apple to create the next iPhone, the next big thing.
Absolutely vital. Then you have selling, general and administrative expenses, SG&A. This is a broad category.
Like marketing, sales team, salaries, office rent, HR, legal.
All of that. Basically the overhead of running the company.
So if you take gross profit and subtract these operating expenses, R&D and
You
SG&A.
get operating income. This is a key figure. It shows the profit from the company's main core business operations. It strips out financing costs and taxes for a moment.
A measure of core profitability. Got it. What comes after that?
Then you account for other income and expenses, things not related to the core operations. Maybe interest earned on their cash pile, or interest paid on debt, gains or losses if they sell off an old factory, or swings in foreign currency.
Kind of miscellaneous items?
Sort of, yeah. And after accounting for all that, and crucially, after subtracting taxes, you finally arrive at the famous bottom line, net income.
The final profit number everyone talks about.
Right, but like I stress in my analysis, you can't just look at that one number. You have to ask, is it quality earnings? Is it consistent? Or was it boosted by some one-off event?
That's a really important point. What else should people watch out for when looking at an income statement?
Well, one thing is timing revenue recognition. Remember, income statements use accrual accounting. Revenue is booked when earned, not always when cash arrives.
So profit might not equal cash flow in a given period.
Exactly. Think of a company selling long-term subscriptions. They might book a whole year's revenue up front, even if the customer pays monthly. That can skew things.
Okay. What else?
Non-recurring items. One-time things like a big gain from selling off part of the business or a large restructuring charge. These can make profit look unusually high or low in one period. If they happen too often, it might be a red flag.
Hiding underlying issues, maybe?
Could be. Also, be aware of expense management tactics. Companies can sometimes legitimately influence reported profit, like choosing to capitalize an expense, treat it as an asset, versus expensing it immediately, or changing how they calculate depreciation.
Depreciation. That's the PP&E wear and tear again, right?
Right. And there are different ways to calculate it. Straight line spreads the cost evenly. Accelerated methods take more cost up front. The method chosen affects the profit reported each year. Consistency is key here.
So lots of nuances behind the numbers.
Definitely. You always need context. What's happening in the industry?
Oh.
How are competitors doing? What's the economic climate? What's management strategy? Is the revenue sustainable? It's not just about the numbers themselves.
Absolutely. Okay, actionable takeaway time. Maybe find an income statement for a company you know and just try to spot the big categories. Revenue, PGS, R&D, SG&A. See how they flow down to net income.
Perfect. Just getting familiar with the layout is a huge step. Okay, ready for the third musketeer? The cash flow statement.
Yes, the cash flow statement. As you said in the article, maybe the most straightforward, the most honest. It tracks the actual cash moving in and out.
Couldn't agree more, because that saying is so true. Revenue is vanity, profit is sanity, but cash is reality. A company can look profitable on the income statement but go bankrupt if it runs out of cash.
Cash is king, as they say.
It really is. Think of it like the company's bank statement, but way more detailed. The basic idea is simple. Ending cash, starting cash, plus cash in, cash out.
Makes sense. How is it structured?
It's broken down into three main activities: operating, investing, and financing. Let's start with operating activities.
This is cash from the main business, right? Day-to-day stuff.
It's exactly. Cash inflows here for Apple would be cash received from customers, buying products, paying for subscriptions, maybe licensing fees,
And outflows?
paying suppliers for parts, paying employee salaries, paying for marketing, rent, utilities, and paying taxes. Actual cash paid out for operations.
Okay. But didn't we say net income isn't the same as cash? How does this section handle that?
Great question. This section starts with net income from the income statement and then makes adjustments to get to actual cash. It adds back non-cash expenses like depreciation.
Because depreciation reduces profit but doesn't actually use cash.
Right. And it adjusts for changes in working capital. For example, if accounts receivable went up, it means they made sales but haven't collected the cash yet. So that reduces operating cash flow relative to net income.
Got it. It reconciles profit to cash.
Precisely. And Apple, wow. As I noted, their operating cash flow in 2024 was over $118 billion.
Yeah.
Just phenomenal cash generation from their core business.
Incredible. Okay, what's the next section? Investing activities.
Yes. This tracks cash used for or generated from long-term assets and investments. It shows how the company is putting money to work for future growth.
Like buying new buildings or equipment.
Yep, that's capital expenditures or CapEx, a major outflow usually. Building new factories, opening stores, buying servers. Also includes cash spent buying other companies, acquisitions, or buying investment securities.
Can cash come in from investing activities?
Sure. If you sell off old equipment, sell a building, or sell some investments or a business unit, that brings cash in.
So this section tells you about their long-term spending and strategy.
Exactly. Looking at operating cash flow versus investing cash flow is really insightful. Is the company generating enough cash from operations to fund its growth investments?
Okay. And the final section, financing activities.
This shows the cash flow between the company and its owners, shareholders, and lenders, creditors, how the company raises capital and returns it.
So cash comes in if they...
If they issue new stock or take out new loans or issue bonds, that brings cash into the company.
And cash goes out if they...
If they pay dividends to shareholders, buy back their own stock, or repay debt principal, that's cash leaving the company through financing activities.
And for Apple, this section shows them returning tons of cash, right?
Absolutely. Huge dividend payments, like over $15 billion in 2024, and massive share buybacks. They generate so much cash, they can fund operations, invest for the future, and return billions to shareholders.
It really highlights how interconnected these statements are. A single sale hits revenue on the income statement.
Right. Affects inventory or receivables on the balance sheet.
And eventually shows up as cash from operations on the cash flow statement.
You got it. They all tell part of the same story.
So from an investor's point of view, what key questions does the cash flow statement help answer?
Several crucial ones. First, the quality of earnings. Is that reported profit backed by real cash?
Oh.
Is operating cash flow consistent, sustainable?
Good point. What else?
Financial strength. Can the company fund its growth internally? Does it have enough cash for its obligations? Is management deploying cash effectively? And shareholder returns. Are dividends sustainable based on cash flow? Are they balancing reinvestment with returning cash? How are they using excess cash, buybacks, dividends, acquisitions?
Okay, really practical insights. Actionable takeaway for this one.
Yeah, a simple but powerful check. Grab a company's statements for a few years. Look at net income on the income statement and cash flow from operations on the cash flow statement. Do they generally move together? Is operating cash usually higher than net income? Often. That's a healthy sign.
Nice. Compare the bottom line profit to the actual cash generated by the business.
Exactly. Strong, consistent operating cash flow is often a sign of a solid business. Okay. Now for the payoff. Using all this to make decisions.
Right, because understanding these statements isn't just academic. The goal is to make smarter investment choices. So let's apply this maybe using Peter Lynch's ideas to Apple.
Sounds good. Lynch always emphasized knowing what you own. His first step was categorizing companies. Where does Apple fit?
Well, in my article, I positioned them as what Lynch might call a stalwart, or maybe a medium growth company now. They're huge, dominant, but their explosive growth phase is likely behind them.
Yeah, that seems fair. Their growth rate, maybe around 11% compounded over the last 5 years, is solid, but not spectacular compared to, say, smaller tech disruptors. It's about half the industry average for that period.
But their resilience is incredible. They sailed through the '08 crisis, the pandemic, often growing strongly even when things were tough.
True. That, plus their consistent dividends for over a decade now, points to a really strong, mature business with disciplined management.
Okay, so it's a strong, mature company. But what about the price? Valuation is key for Lynch.
Absolutely critical. Let's start with the PE ratio, price to earnings. Apple's is around 41 right now.
41, that sounds high. Lynch liked PE ratios roughly in line with growth rates, didn't he?
Generally, yes. An 11% grower with a 41 PE, that raises a flag. It suggests the price might have gotten ahead of the earnings growth.
And you use Lynch's other metric in the article too, the one combining growth and yield.
All right, the PEG ratio variant, earnings growth rate plus dividend yield PE ratio. For Apple, that comes out to roughly 0.24.
And Lynch liked to see that ratio ideally around 1 or even better, 2.
Exactly. Below 1 is often considered overvalued, and 0.24 is, well, significantly below that threshold. It strongly suggests potential overvaluation based on his framework.
So that 41 PE means it would take 41 years of current earnings to match the price paid for the stock.
Assuming earnings stay flat, yes. You have to ask, is the future growth potential really strong enough to justify paying that multiple today?
Tough question. But on the flip side, their financial health looks amazing, right? that cash flow.
Undeniably strong. Over $110 billion, $118 billion in operating cash flow the last couple of years. That's just a staggering amount of cash being generated.
And they use it well, investing in R&D, making acquisitions, paying dividends, buying back stock.
Right. The consistency of that cash generation is a huge plus. It shows the fundamental strength of the business model.
Of course, there are other metrics people should look at. Gross margins, debt levels, inventory turnover, things that professionals analyze constantly. As I mentioned, it's worth digging into those yourself in their reports.
Absolutely. You need the full picture. But putting it all together for an investment decision on Apple right now?
Yeah. What's the conclusion?
Well, the fundamentals are incredibly strong. Resilient business, amazing cash flow, great brand. But that valuation is a major hurdle.
So potentially a great company, but maybe not a great stock price at the moment. Like you concluded in the article, materially overvalued.
That's how it looks using Lynch's framework, yeah. Similar to some other big tech names right now, the price seems to reflect a lot of optimism, maybe too much.
But the lesson here for aspiring investors, the Peter Lynch philosophy, isn't just about saying yes or no to Apple today.
Not at all. It's about the process. Lynch believed in combining your own experience, understanding businesses you encounter, with this kind of fundamental analysis.
Looking at the numbers, understanding the story they tell.
Exactly. That's where you find those potential 10 baggers or more. It requires both the quantitative digging and the qualitative understanding of the business, its competition, its management.
And patience. Waiting for the right price.
Patience is paramount. Don't chase stocks just because they're popular. Wait for an attractive valuation.
Okay, great summary. So wrapping up this deep dive, the big takeaway is understanding these financial statements gives you power.
Real power. It lets you move past speculation, past headlines, and make informed decisions based on actual business performance.
Knowing the balance sheet, the income statement, the cash flow statement, how they work, how they connect, that's your toolkit for assessing financial health.
It truly is.
So a final thought for everyone listening. Next time you buy coffee or use an app or see a truck drive by, think about the company behind it. Start looking at their financials online. See what story the numbers tell you.
You might be surprised what you learn. And if you want to go deeper, get more comfortable with these concepts, find more articles and resources on value investing.
Then definitely check out bullishbooks.com. Lots more content there to help you on your journey.
Yeah, plenty of tools and analysis to build your skills.
Absolutely. And make sure you subscribe to the deep dive so you don't miss our next exploration into essential financial knowledge. Thanks for tuning in today.
Thanks, everyone.